Hello traders, Gary Wagner here. It is Friday, finally the 6th day of July 2012, and this is the daily report for gold and silver, our weekend review. Virtual bloodbath in the markets across the board as U.S. jobs reports come in even under the tepid expectations of 100,000 new jobs being created. The actual number came in less than that by 20% at 80,000. Interestingly, ADP put out a report that it might be as high as 175,000. Boy, they did get that one wrong. 2150, that's the net change on gold, lower, closing at 1583.40. 1582.40 bid-ask spread with a low of 1575 and a high of 1611. Silver also hit pretty hard, down 60 cents, 27.20 is the closing price, 26.85, 27.86 is the high, low 26.86. Traders, about the only thing that we saw move in the upward direction today was the U.S. dollar. We have had this dollar really raging, as you can see, since about 82, currently trading at about 83.50. Stock market, of course, that was down. Dow Jones Industrial Average down almost 125 points on the day. Crude oil also down almost $3, 277 lower to close at 84.12. Traders, to give you a more clarified, a clearer picture, so to speak, of the dollar index, I've gone ahead and pulled up a Henkin-Ashi continuous contract dollar index in the weekly format. Each of these Henkins represent, or Henkin candles, represent 1 week in time. When we look at some of the historical highs that we have seen in this market, 93 and 95, and we relate that to our current place, which is just right around 83, 83.50 is where it closed. There is actually room on the upside for this dollar to travel in terms of historical lows, recent lows, right around here at about just above 75. As you can see, it's been slowly tracking. It could hit some resistance on a technical basis in this area, and this is based upon the tops in the market that we saw. This is back actually 2 years ago, October of 2010. This is beginning of 2011 and 2012 here. So we could run into some resistance here and then see the dollar move a little bit lower. That's something that time will tell. We'll get some sort of indication or follow through come Monday and Tuesday, the beginning of next week. Traders, when trying to make sense of any kind of market moves, technically, what I tend to do is take a step back. So in that spirit, we're currently looking at a weekly chart. It is of the continuous contract of COMEX gold. I've put up two Fibonacci retracement sequences. We've used these before, but just to highlight, the long sequence is the entire bull run that we get from, call it October of 2008, all the way up to the record top at 1920. The secondary Fibonacci retracement that I run starts at about 1179 and also goes up to the top. And really what I'm looking for is key areas that we call Fibonacci harmonics. And as you can see, the 23% retracement level, 1646, matches up very closely to this 38% retracement level, which is 1645. Now, the other level that shows us a Fibonacci harmonics, and I had to add it back in. I didn't realize that I did not include the 61% on the shorter of the two, but you can see that right in these two areas, we have very, very strong Fibonacci numbers that are coming through. Now, when I say strong, I'm simply referring to the fact that they have a harmonics attached to it, meaning we can use two different cycles and come up pretty much with the same answer right here, and right here. So these, to me, are going to be defining and critical areas in the market. This one being just below 1500, then 1645. Now, The last one that we'll take a look at is 1556. It correlates to these tops here, but also to the bottom activity in the market. Now, what does this tell us? In essence, what we are looking at when we consider these three levels is the first certainty that we can say in terms of what we have seen and what we have not seen is that we have had the inability, this has become major resistance. There can be no doubt about that. We have strong resistance here. The market has not been able to make it above that. Support, well, we can see defining support right in here. We talked about this area, which is about the 1532 area. This comes up at 1556. It doesn't account for these lows here, but this is a very strong band of support. The market has genuinely been trading right within these defined areas for a good period of time, predominantly for about the last 2 months. Now, if the market cannot hold this one level here, if it does retrace, if it continues to go lower, my target has got to be right in this area because we have such a strong harmonics in this area, 1469, 1467. There can be no doubt that's a very strong area. If it can hold, it looks like right now that it's trading in a range-bound manner because it has not had the ability really to trade in anywhere above this 1640 area. This has been very strong resistance for the marketplace. Here's support. Our next levels, of course, and I'm talking about if it breaks through either the upside or it breaks to the downside. The downside would be 1467. On the upside, the next target would be 1755. But traders, prior to that, it's got to be able to break out of this range one way or another. Traders, we're taking a look at a daily chart. This is the cash market, and it's also one of the charts that I use for Elliott wave count. You know that as of recent, I have not been working with the Elliott wave count because it's gotten very difficult for me to, with 100% certainty, at least in my mind, that we've got a correct count. As best as I can fathom, there are a couple of facts that I do believe are fairly clear. The first thing is that we are still in a corrective phase. We're still in this major fourth wave, and I still believe that we have a major fifth wave to move up and take out these record highs at 1920. Are we there? Absolutely not. We've gotten no evidence yet that this fourth wave's corrected. And I almost feel like the boy that cried wolf in that I have felt it had ended on a couple of occasions, specifically right in here, that got us long. Now, we made $120 on this trade. This was a great trade, but once this market hit this double top and could not take out this record high, we realized that there was something more at play than a standard count. One possibility is that as this market moved up, this was the beginning of the fifth wave, and you got a fifth wave failure. I personally don't think that that's what we're seeing. I think that what we are seeing right now is this very long, protracted correction. We have had these series of corrections that have taken a couple of months to play out, but not to this degree. If we take a look historically speaking, 2 to 3 months possibly. Now, when we take a look at this is back in September, we hit our record top, and we're all into July. In other words, we're not that far away from a 1-year corrective period. Now, we also see that if we look at this marketplace from fresh eyes, meaning you know that it had broken below the former triangle, but when we look at it from fresh eyes, we can still see that we are in this not only consolidating pattern, but this compression pattern. And what I mean by that is, as you know, anytime this market or any market will compress, where you get a series of lower highs and a series of higher lows, you have energy building, you have a compression triangle that's building, and it falls within that parameter because you can see it's tightening. Now, it could break like it did before to the downside or to the upside. If it's going to follow straight Elliott wave forecasting techniques, meaning if the wave count will hold true, one possibility, and again, this is just a possibility, but in terms of the 5 legs, we've got 1, 2, 3, 4, 5, and then you get your thrust. That is still one distinct possibility. I did want to at least acknowledge that the potential is there, but at the same time, I want you to realize that this is one of 2 different wave counts that I've been working with, but I feel comfortable right now in at least looking at this potential of the market still being in a compression triangle. Now, as far as silver goes, there's no doubt there is pressure on this market also. We have had these real tight ranges in which we have had a succession really of lower highs. At the same time, we've gotten some very, very good support in terms of a triple bottom in the market. Until I see otherwise, my sentiment right now is that this $26 area should hold. For if it does not, we really don't have any kind of technical support or resistance through the area of, call it $26 down to about $20. You can see there's almost a straight linear line up. We get bands of support / resistance right in here. This is really a very, very strong area, and then 30.36 is a very, very strong area. However, until the marketplace trades through the week next week and we can see if it wants to test this area again, my sentiment is that the $26 mark should hold in silver. We'll just have to see. This has been Gary Wagner wishing you, as always, good trading. We'll talk to you on Monday for another daily update and review. Bye-bye.